Hello, traders. In this video, I will tell you about imbalance, unfair cost, price gap, or ineffective pricing. This formation has many names. Call them whatever is more convenient for you. The meaning will not change. Today, I will tell you my secret formula that I use in the market to make a stable profit. Why am I? My 8-year-old son is trading it with incredible success. We will also consider the inversion imbalance and the rule for its construction. Let's look at several examples of transactions opened according to the logic of today's topic. And, in general, we will have a pleasant time. Pour yourself your favorite drink or something stronger, stock up on various goodies, enjoy watching everyone. So, what is imbalance and how can you spot it on a chart? Why is everyone talking about him like that? And is he really that good? If so, then which imbalance should be addressed and which should not? Let's talk about this. Knowledge, and most importantly, the correct use of imbalance, can direct your balance scale straight to the heavens. And for this, you need to watch this video to the end. But before we start talking about it, you need to subscribe to my channel and like this video. After all, everything I do is done for you and your development as a trader. First, let's look at an example of what price inefficiency looks like for selling and buying. An imbalance is a pattern of 3 candles, where the low of the first candle does not overlap with the high of the third candle. And if the shadows of the first candle and the third ones touch, then a gap has not formed, which means there is no imbalance. For purchases, the formation rules are similar, so let's not waste time. Now let's look at the examples on the chart. Let's note all the price gaps that form during an uptrend. As you can see, several imbalances are formed during price movements, and sometimes there are a lot of them. The question arises, so what imbalances need to be noted? To answer this question, we need to understand the very logic behind the formation of the price gap. This may sound complicated and daunting, but I assure you, in order to understand this, we do not need super abilities or super strength. So, an imbalance is an area or zone in which, during an impulse price movement, price inefficiency was formed. In simple terms, this is a zone in which the presence of one player was many times greater. For example, during an upward impulse movement, the number of buyers was greater than sellers. If there are more buyers, then who sells to us? For this purpose, there is a market maker on the market who, under an agreement with the exchange, undertakes to execute the orders of each trader. But since the market maker undertakes to execute orders that bring him only losses, it is in his interests to return the price back to the price gap zone in order to close his unprofitable positions to zero, thus covering the zone of ineffective prices. I often give this example with a market maker in my videos, since knowledge about patterns alone is not enough, and we need to understand the logic of the formation of this or that price movement. So what am I talking about? I wanted to tell you something interesting and forgot. Well, okay. We have figured out how the imbalance is formed and its overlapping logic. Now let's look at how it can be used in trading and what price gaps will interest us. We know that the price moves in accumulations and impulses. In smart money, savings are called flow order. But we also know that any flow order is a block order of a higher time frame. Can you guess what I'm getting at? If, of course, you know that a flow order is a block order, but only on a higher time frame. If not, then I talk about this in detail in the video about secrets of block order on my channel. I recommend viewing. A hint for this video appears in the upper right corner. Click and see, but only after you watch this video. What rules do we need to mark an order block? Right. A block order is a candle that removed liquidity, and after its formation, an imbalance was created. This does not mean that the price must reach our order block. No, we don't need that, Eid. For us, the formation of a block order provides information that a major player has blocked the orders of other market participants, and means that with a high degree of probability, he will continue to push the price in the direction of the trend. In this whole situation, we are only interested in the imbalance from which the price will rebound. Up on touching the price gap, fill it by half or cover it completely. Pay attention to the graph. Here you see the trading volume accumulation zone. The price impulse leaves the accumulation zone, leaving behind zones of untraded price inefficiency. Now let's look at the logic behind the formation of this imbalance. Above the accumulation, stop orders were placed for traders who were selling from the upper limit. Their stop losses are opposite buy orders. When the price takes them, the momentum strengthens. Why amplification? A major player has already laid down a large volume in order to push through the seller's volume, and when seller's stop losses are added to them, the price impulsively rushes up. Since in this zone there were mostly only buyers, the market maker needs to return the price back to the imbalance zone in order to rebalance it. I hope you are not tired of watching the video and watch it with great pleasure. Then let's continue. What imbalance zones can be taken into account when a large movement has occurred, or in other words, a wave movement. In this situation, we need to use the Fibonacci grid and premium or discount zones. If we consider the situation for sale, then everything that is in the premium zone, and these are imbalances or order blocks, they have an unlikely percentage of completion. We will only be interested in the discount zone, and already in it, we highlight all order flows, and in them, we note imbalances. A reinforcing factor will be the presence of an imbalance zone on a higher time frame. To do this, you just need to switch time frames and pay attention to the presence of a price gap of higher time frames in the premium zone. To make purchases, you do all the same steps, only in the opposite direction. There's nothing scary or complicated here. After all, bears were taught to ride a bicycle and monkeys were taught to shoot guns. Do you think trading the market is more difficult? You just need practice, a lot of practice. The more you trade, and preferably 1 or 2 setups, the more observation you develop and the more you understand what is happening or will happen in the market. Remember, it is advisable to look at the imbalance on higher time frames, since they will always be a priority over the imbalance of the lower time frame. For example, if you marked a block order on an hourly time frame, and above it there is a price gap of a higher time frame, then most likely the block order will act as liquidity, and a reversal will occur from the imbalance zone. Also, the price gap should be used according to the trend. After the price has formed a trend break, we can consider imbalances only in the current price direction. But if you don't want to understand and mark trend structures, then you can trade from local or global liquidity. I explained and showed this information in detail in my video about order blocks. Today I mentioned that my 8-year-old son is also involved in trading, and so it is. I gave him a strategy with minimal rules and market knowledge. I didn't go into detail about his strategy in this video, but I promise you that I will make a detailed video tutorial on it. I do everything I planned, so I'll probably finish this video. I wish you good luck and more profitable days.